Hey folks, we're going to jump into lecture 5.2, which is talking about adjusting entries. This is part of the chapter 4 materials. So adjusting entries are entries that occur based on timing issues typically. We make adjusting entries depending on company policy. Sometimes we do these on a weekly basis, monthly basis, once a quarter, or sometimes once a year, depending on how the company, how the organization treats them. Adjusting entries are required to bring accounts up to date. There are times that items just don't get recorded on a day-to-day basis. There's times that accounts have expired or and they just haven't been brought up to date, or there's times that we just simply haven't recorded information as of yet. And so we need to make an adjusting entry to bring our accounts up to date. There's two different types, general types of adjusting entries. The first are prepayments. And typically we deal with prepaid expenses or unearned revenues. Both are considered prepayments where we've paid something up front and it's expired, or where we've received some money up front and we haven't yet completed the work. So in prepaid expenses, there's two different types. Either we have expenses that were set up as a prepaid, as an asset, and over the period they've expired. They no longer, the time has passed. Or other times we've set up and paid an expense up front, but we haven't actually used all of what we paid for. So there might be a time that we have an expense that we need to convert to a prepaid. Also in unearned revenues, so when we've collected money from a customer and we haven't done the work yet. Okay, the other type of adjusting entry would be what we call an accrual. And accruals are quite simple. We should have some comfort with those already. So anytime we have revenues that we've done the work, but we've not yet collected the money, we're going to have what we call an accrued revenue. And in that case, we may not have recorded that this is done yet, but at the end of the quarter, we look around and heaven forbid we've finished this work and we have to send out an invoice to our customer. And so we want to recognize the revenue and set up an accounts receivable. Or we have an accrued expense where we've utilized something in our operations. We've used the expense to generate revenue somewhere in our organization, but we've not yet paid for it, or we haven't received our invoice yet, and so we want to recognize the expense and set up an accounts payable or accrual. So let's take a look at the journalizing of adjusting entries. So first let's look at prepaid expenses. So there's a couple questions we need to ask. The first is how much of the prepaid amount has expired, and then we want to recognize the expense and reduce the asset, our prepaid expense. So let's go through an example here. So on January 1st we have ABC Company, and they paid $12,000 for the year's rent, and they established a prepaid rent account when this happened. Their fiscal year end is September 31st, and they have to make an adjusting entry. So we're assuming here that ABC Company adjusts on an annual basis, so at their fiscal year end, they need to make an adjustment. So the first question is, we have a prepaid expense that's set up. All right, we have it here for $12,000 at the beginning of the year, and we know that $12,000 of rent is still not available to us, or still not paid come September 31st, and so we need to reconcile the difference. We need to recognize that we've been in a space for the past 9 months, and we need to recognize the expense. So first question we ask, how much has expired? So we started off with a cost of $12,000. 9 months out of 12 have expired, and so we've used up $9,000 of rent. So we need to now recognize the expense. So on September 31st, we're going to recognize the expense via debit to rent expense, and we're going to reduce our prepaid rent, so reduce our asset by $9,000 with a credit. What this is going to do to our T account, so up front we paid our $12,000. At the end of the year, September 31st, we're going to recognize that $9,000 of that prepaid rent is no longer there. And we still have another 3 months that we don't have to pay our rent. It's already been paid up front, and so we still have $3,000. So come October 1st, the beginning of our next fiscal year, we'll have an asset valued at $3,000 on our balance sheet called prepaid rent. And that'll pay for October November, and December. The next type of prepaid expense would be the opposite, where when we paid an amount, we recognize the full thing as an expense, but there's still some that remains at the end of the period. So for example, we have XYZ Company. They paid for a year's subscription to a telemarketing service on June the 1st. And so on June the 1st, they recognized the full year subscription as an expense, and they paid cash for it. So XYZ completes its adjusting entries at the end of each quarter, and their quarter 2 ended October 31st. So one quarter has gone by, and we need to complete an adjusting entry. And so we have this expense on our books called marketing expense, but we know that we haven't actually utilized the full $8,500. We've only utilized a few months of this subscription. And so we want to figure out how much of this has expired. So again, our total cost for the year, $8,500, times the number of months that have passed. So we had June, July, and August, 3 over 12. So really our marketing expense should only be $2,125. And so what we're going to do is we're going to reduce our expense and set up a prepaid. So we're going to set up a prepaid for the unexpired amount. So out of the $8,500, $6,375 is still available, or is for the rest of the year in this marketing service. So we're going to set up our prepaid marketing, our asset, and we're going to reduce our expense by a credit for that amount as well. And so if we looked at our T account for a marketing expense, we started off with $8,500. We removed $6,375, and so at the end of the quarter, we should have $2,125 as our actual expense, the amount that's actually gone through. My goodness, if you can read that, check and scratch, that'll be great. My apologies. Okay, let's take a look at unearned revenues, another prepayment. This is where we receive money for work that's not completed yet. So let's look at George's Limited. They've received a $50,000 down payment on October 1st from customers to build a house. At the end of their fiscal year, November 31st, George has not yet started construction. So when we received, so now we want to record the adjusting entry for the $50,000 received. So we need to recognize the cash that we received, $50,000. We haven't done the work yet, and so we're going to put it in what we call an unearned revenue account, and we'll credit that. Unearned revenue is treated like a liability. We have an obligation to provide services for this customer because we've received cash. So assume now that we're at December 31st and George has completed a portion of the home equivalent to the down payment amount. So we've earned that $50,000 now. So we're simply going to remove it from our liability. We no longer owe the customer $50,000 of work, and we'll recognize it as an expense. Okay. The next type of adjusting entry, as we chatted about, was accruals. And again, this is where we've either completed a service and not yet received the funds, or we've incurred an expense and not yet paid for it. So let's look at ABC Company, who's completed services of $1,000 for John Doe, a regular customer, and they've just mailed John's invoice out. They're going through their books and they need to do adjusting entries for this period. So the work has been done, so we've incurred expenses to provide John the work that we've done, and so we need to recognize the $1,000 of revenue of work that we've done. And we're going to set up an accounts receivable for John Doe because we haven't yet received the money. We just sent out the invoice. As well, in accrued expenses, we might have XYZ Company that purchased $800 in advertising for the month and has not paid CBHM, the radio station, as of yet. So again, the ad has already been on the air, and so we need to recognize the expense. We probably generated a bit of revenue based on having that advertisement out there, and so we should recognize the expense in this period. And maybe the radio station just hasn't sent us out our invoice yet, but we know what we owe them, and so we should set up an account payable for the same amount. And that's how accruals look. So these adjusting entries are very important for us to ensure that we're providing accurate and timely information to readers of financial statements. So we'll go through and practice a few other adjusting entries, and then our post-adjustment trial balance. Again, as these adjusting entries touch numerous accounts, we want to make sure that after we posted these entries, that all of our accounts are still in balance and that we can proceed with the next steps in our accounting cycle. Thanks much, and have a good day.